Welcome. Today's video I am analyzing Avanti Feeds Limited. The company was set up in 1993 and it manufactures and sells shrimp feeds and exports processed shrimps. It has total shrimp feed capacity of 6 lakh million tons per annum, of which 60,000 million tons per annum is in Gujarat and the balance is in Andhra Pradesh. The company had hived off its shrimp processing division into a separate company called Avanti Frozen Foods in FY17, which has a shrimp processing capacity of 22,000 million tons per annum. Avanti Frozen Foods also has 4 windmills in Karnataka with a power generation capacity of 3.2 megawatts. Avanti Feeds is the largest shrimp feed producer in India with an installed feed manufacturing capacity of 6 lakh million tons per annum MTPA. The company commands a market share of approximately 45% in the domestic feed business. The company is also one of the leading shrimp exporters in the country. The regulator Marine Products Export Development Authority oversight adds credibility to the Indian products and improves competitiveness in the exports market. The authority has played an important role in regulating shrimp production through measures such as proper maintenance of ponds, density of cultivation, registration of hatcheries and shrimp ponds, procurement of seeds from notified hatcheries, and increasing traceability of the shrimp to pond and seed level. These measures help in establishing Indian shrimp producers' competitiveness in the international markets. It also reduces the risk of catastrophic viral attacks. The country's large coastline, moderate climate, these are conducive for shrimp aquaculture across large geographic areas, further reducing risk of viral disease outbreak. The company has sustained its strong credit metrics and increased its scale of operations while consolidating its position as the market leader in the domestic shrimp feed category. Despite volatile operating environment, FY19 revenues increased 2.8% YOY to INR 3,487 crores. FY19 EBITDA margin, however, contracted to 11.7% from where it was in FY18 at 20.1%. FY18 was a strong year for the company, but it was followed by weakness in the global shrimp demand that impacted the FY19 results. There has been a gradual recovery in the global demand and shrimp prices, leading to modest rebound in the shrimp aquaculture. For half year ending FY20, 1920, revenues increased to 2,157 crores, which was earlier 1,794 crores in the first half of FY19, while the EBITDA margins increased by 90 basis points to 12.3%. Earlier it was 11.4%, reflecting the increase in volumes. We can expect EBITDA margins to remain stable between 10 to 12% range in 2020 and FY20 and FY21, but this is contingent to stable global shrimp prices, while higher share of value-added products in the processing division offsets the margin pressure from the intense competition in the sector. The company has remained net debt negative since FY15 and its gross interest coverage, that is interest coverage, EBITDA divided by total interest expenses was 155 times. So company's interest coverage is quite comfortable in FY19. FY18 earlier it was 220x and FY17 115x. So basically the company's interest cost is very low because the debt is very low. The income tax department had conducted a search on the premises of both the companies from 7 to 11th November 2019. It did not impact the operations and the authorities have not initiated any action or proceedings such as freezing of bank accounts, seizure of stocks, etc. A company called Thai Union holds around 24.2% stake in AFL, that is Avanti Feeds, and 40% stake in Avanti Foods subsidiary, Avanti Frozen Foods Private Limited. This company is among the world's largest shrimp, fish and pet food manufacturer and processed seafood producer, with a strong marketing and sales network worldwide. Therefore, this strategic partnership provides Avanti Feeds with a technical know-how in feed formulation, leading to industry-leading feed conversion ratio and shrimp processing and access to its global marketing network. The joint venture has the first right of refusal and non-compete clause for a period of 5 years. The company has shown a healthy cash balance of 589 crore as of fiscal year 19. The company's term debt repayment requirement is minimal. That is, the overall debt repayment is very low. Cash flow from operations is continuously increasing and it is 201 crore as of FY19. In FY18 it was 289 crores and in FY17 it was 282 crores. So the cash flow is quite stable over the years, owing to increased scale and robust working capital management. The cash flow from operations is sufficient to fund the company's dividend payment and modest capex requirements. The company uses its fund-based facilities sparingly, with fund-based facilities remaining unutilized in FY19. The company has a lot of bank credit, but they have not utilized that. While the average utilization for Avanti Frozen Foods during the 12-month ended November 2019 was about only 4%. So the other subsidiary of Avanti Feeds has used only 4% of their fund-based facilities. We can expect to see a strong free cash flows in FY20 and FY21, since the company has a very modest capex requirements and also has a stable dividend policy. The company is exposed to raw material price risk. However, it has the pricing power in the feed business, since it dominates the market in Andhra Pradesh, where the company has more than 50% of the market share and over 60% of the installed capacity. The company has exhibited its ability to manage raw material price volatility effectively during the FY15 to 19 period. However, a prolonged decline in global shrimp prices could impact farmers' affordability for higher shrimp feed prices, and in the long run it may be detrimental to India's shrimp aquaculture growth, adversely impacting the company's feed division. Indian farmers have shifted focus to Venami shrimps since 2010, which have a higher cultivation density and are less prone to viral attacks. Also, the spread of shrimp culture to various locations across India has helped the company to eliminate location-based disease attack, leading to stable shrimp production and the consequent feed demand. Therefore, it is very important to understand that any kind of problems in terms of disease in the shrimps will cause a lot of problems to the company. In case of disease outbreak, the impact would be high, affecting the company's feed and processing divisions both. So the company not only makes feeds or to feed the shrimps, but also does the processing and exporting of shrimps. Deterioration in the scale of operations or EBITDA margin due to industry or company specific factors is a negative, which will lead to a significant deterioration in the credit metrics, and it would be negative for the company. Let us look at the industry overview and what is the future forecast for it. In the initial reaction to the pandemic, the shrimp culture, that is cultivation of shrimps, stocking slowed down during the April and May 2020 period, apprehending a fall in export prices and export market. The quarter 1, April, May, June are the months during which stocking takes place intensively. The production levels are forecasted depending on the stockings and extent of culture area which were missed in first quarter of 21. There was also shortage of shrimp seed from hatcheries, as the normal operation of hatcheries were affected by lockdown. So during this first quarter, not only the overall production had reduced, but there was a shortage of shrimp seeds as well as from hatcheries, and therefore the amount of shrimp production has definitely come down. The things have improved gradually, with farmers gaining confidence due to more or less stable farm gate prices and resumed stocking, and the shrimp culture is in progress now. The shrimp production in India has registered a growth of about 10 to 12% at 8 lakh tons in 2019 as compared to 6.85 lakh tons in 2018. Shrimp feed consumption has registered a growth of about 10% at 11 lakh 50,000 tons in 2019 compared to 10 lakh 20,000 tons in 2018. Due to COVID-19, the global demand as well as production is expected to come down by about 10 to 15% in 21 compared to FY20. Based on the present shrimp culture situation in India, there may not be significant, that is not more than 10 to 15% downfall in shrimp production in the country during FY21, provided the impact of the COVID-19 will not have severe negative impact on export market of shrimps from India. Feed consumption in India during FY 2021, let's look at that. In view of the anticipated drop in shrimp consumption globally by about 15 to 20%, correspondingly shrimp production is also likely to come down, and shrimp feed consumption in India during 2021 is expected to be around 10 lakh metric ton or million tons as compared to 11.5 lakh MT in 2019. So because of this COVID-19, not only the overall demand for the shrimps globally has decreased, but the production will also have to be decreased correspondingly, and therefore the feed business will also be affected slightly from 11.5 lakh MT million tons in 2019 to around 10 lakh million tons. The company's sales are expected to be maintained at the same level. The company has not only been keeping its farmer base intact, but it is also adding new farmers, new areas to its sales network every year. During FY21, the company is also expecting to maintain its market share between approximately 46 to 48%. Now let's look at shrimp processing and export business. Shrimp production and export from India in 2019 was around 8 lakh tons, and it is expected to be around 7.25 lakh tons in 2020. Slightly reduced from where it was in 2019 due to this COVID issue. As far as the company is concerned, during FY20, 13,397 tons of processed shrimps were exported as compared to 11,065 tons during the FY19 period, and thus registering a growth of around 21%. The growth is mainly due to continuous focus on export of value-added products and also exploring opportunities in new markets. Let us look at how the government is supporting this industry. The government's policy of economic revolution through Blue Revolution has given shape to the scheme Pradhan Mantri Matsya Sampada Yojana for fisheries in May 20, with an investment of over 20,000 crores in the next 5 years. This scheme basically aims at increasing the fish and shrimp production in India at a growth rate of around 9% from 137.58 lakh million tons in 1819 to around 220 lakh million tons by 2024-25. And this scheme is, if implemented in the right earnest, will go a long way in the growth of seafood industry. This concludes my detailed company profile analysis. Next, let us look at the financial statement and understand how the company's financials are. Before we look at the company's financial statements, let us look at the summary of the financial statement to understand on which part we can focus on. So on the left hand side, I have the balance sheet, with total capital of 1880 crores. The result is up to date till March 2020. Let's look at the source of funds. Most of the money the company has is in terms of equity or net worth of almost 75%, and the company's debt is just minimal 2 crore rupees. Other liabilities is around 25%. Let us see how that capital is distributed. Assets are around 14%, investments are around 36%. So when we are analyzing the financial statement, we will focus on these particular high percentages. Receivables is very less, that is, the total debtors are very minimal, so the company is collecting payment efficiently from its customers. Investments is 680 crores. A major chunk of their portfolio is in investments, which generates other income. Inventory is 29%. The company would definitely have a high holding inventory holding throughout the year, because this is a cyclical business, and because the shrimp production and harvesting happens almost 2 to 3 times in a year, and that particular cycle lasts for around 3 months or something like that, and therefore every 3 months or 120 days this cycle keeps happening, where the shrimps are processed and exported. Cash holding is 11%, 199 crores, and other assets is occupying around 48%, 903 crores. So the two main items, which is the other assets and investments, needs to be looked at in a closer details, along with inventory at around 29%. On the right hand side, I have profit and loss account. This is the 12 trailing months profit and loss account. The total revenue generated up till June 2020 is 4058 crores. And let us see how the expenses are in terms of operating expenses are occupying almost 89%. So out of this total revenue, 3531 crores are the operating expenses. So we'll need to study these expenses in greater detail if we want to invest into the company. Most of it is basically feeds, expenses on feeds. Interest cost is minimal at just 2 crores, since the debt itself is hardly 2 crores. The depreciation expense is very minimal at 1%, taxes again just 2%. Net profit in the recent 12 months has come down below 10% at 358 crores. So on a total revenue of 4058 crores, the company's net profit is approximately 358 crores. Now let's move on and look at the company's financial statement in detail. So let's begin our financial statement analysis of Avanti Feeds Limited. We'll begin by looking at the equity percentage and the debt percentage. As we earlier saw, the debt was just 2% of the total balance sheet size of around 1880 crores, and the net worth or the shareholders contribution in the business is 1404 crores, which is 75%. And we can see the trend in the amount of reserves the company is holding every year. It's been increasing from March 15 to March 17, from 56% to 59%, and now 75%. The debt on the other side has been reducing from 12% to now almost 0%. On one side, the company's equity or shareholders net worth is increasing and the debt is decreasing, which is very good. Return on equity is around 24% in March 20, and earlier too in March 15 and 17 was above 30%, which is a very good net profit on the total shareholders contribution in the business. If you look at the averages of last 7, 5 and 3 years, they have remained above 30% on an average basis, although reducing slowly, gradually to around 30%, but even this return on equity is very high. And therefore, once we look at the valuations, you will see that the company would have been highly valued, because it is generating a high return on the shareholders' money. Return on capital employed in March 20 was around 1405 crores. This was the amount of total capital employed into the business. This includes your debt as well as your net worth or equity holders contribution, and on that the company has earned a profit of 489 crores. So we can, or rather the EBIT earned in March 20 was 489 crores, And we can see the upward trend in the EBIT generated from March 15 to March 17 and March 20, from 183 to 342 and now 489 crores. And we can see that correspondingly the EBIT, or rather the return on capital employed, has been decreasing, because the company's total capital employed is increasing, but the profits or the EBIT is not increasing correspondingly, and therefore we can see the percentage drop in the amount of ROCE. So now as of March 20, the ROCE is 34.8%. This is also rather high, and the company has been managing its capital employed, or rather generating a good EBIT on capital employed. If you look at the long-term averages of 7, 5 and 3 years also, we see a very high, above 45% of return on capital employed over the last 3 years, 5 years and 7 years. And this is a very high generating business, or I would say the company is generating a very high returns on its capital employed into the business. Return on total assets again would measure how much profit the company is earning on its total balance sheet size, and we can see the balance sheet size has been increasing every year from March 15 to 17, from 478 to 1069 crores, and now in March 20 to 1880 crores. So the company's size is growing over the years, and the net profit it is earning from 116 to 346 crores is also in an upward trend, although percentage wise this has been dropping return on assets to around 18.4%. I would consider even this as a very good value of 18.4%, but we will have to compare it with its peer group companies to see how the other group companies are generating profitability on their capital, on their assets and on the net worth. The debt to equity is 0 as we saw earlier, and from 15 till March 20 the amount of debt on the company's book was minimal. In fact, rather in March 15 it was just 58 crores, which has now come down to 2 crores. The amount of assets the company holds, net of depreciation, is around 271 crores out of the total balance sheet of around 1880 crores. Earlier we saw in the summary that the company's assets were around somewhere around 14%. So this is correct value, and we can see the amount of assets has been, as a percentage, has been decreasing to around 14.4% of the total assets. And this is a good value, because we don't want too much assets on the company's book until and unless the company is in an expansion mode. So value wise it has increased in March 15 90 crores to 271 crores in March 20. So the asset wise values are increasing, but the percentage wise as of total assets it is decreasing, and this is a good value. Debtors percentage as of total assets is also important to see, as of how much payment needs to be collected from the customers and how much they are occupying as a part of total assets, which is a minimal 4.7%. They should not exceed 30% of the total balance sheet size. Only 89 crores is left pending to be collected from its customers. So most of the money is pending from its customers are collected immediately, so it seems, and therefore low debtors as a percentage of total assets of just 89 crores, although it has increased value wise, but percentage wise it is very minimal. Investments we saw earlier was occupying a large portion of the balance sheet, which is almost 36%, and we can see over the years this has been increasing as a percentage. This would be good, because if the company doesn't have expansion or capex requirement, capital expenditure requirement for its growth, then it can put that money into investing activity. So from 111 crores of investments in March 15, it has been gradually increasing to around 680 crores now in investing activity. When we look at the cash flow statement, and when we look at specifically cash flow from investing, we'll see how that is shaping up. So as of now 680 crores of investments is done by the company, which is almost 36% of the total balance sheet size of 1880 crores. Company's cash holding was also big at around 11% in March 20 at around 199 crores, which has increased substantially from where it was in March 17 at just 45 crores. So the company also has surplus cash holding in its books. So 680 crores of investments and 119, almost 200 crores of cash holding. So company can always use this to pay off as dividend or use it for its expansion activity if it so feels, or acquire other businesses. So there is always a very high growth opportunities in the business because it has surplus cash as well as line of credit, which we saw earlier when we were doing company profile analysis, and it also has huge investments which it can liquidate and use it for expansion purpose. Current capital work in progress, basically development of new assets, is minimal at just 1.4% of the total assets. So only 26 crores of work is going on in building new assets or fixed assets for the company for its future growth. So we can see from this particular analysis that company is not does not have any growth or capex requirement as of at least till March 20, because no work is in progress as of March 20, just 26 crores. Company's inventory holding was high at around 28, and it has, we can see over the years as a percentage it has been decreasing, but as a value wise it is going up gradually as a percentage of total assets. So this is a very good value where it is keeping its inventory holding, not too much invested in its inventory, because that can lead to a lot of losses for the company if the company is not judicious enough or not careful enough in how much inventory it is holding. So it has to, because that has a cost associated with it. There's a procurement cost, there is a credit cost, there is a warehousing cost, and there are many additional costs to inventory. There is a possibility of loss, damage, or maybe virus attack to those shrimps, and so on. So there are a lot of issues with regarding to inventory, and when we see these kind of trend, it is very good to see that as a percentage it has been gradually decreasing from 46% to around 28.9%. As the total assets were increasing, the corresponding inventory holding has not increased that substantially. Sales growth again is very important to look at how the sales have been compounding or how the company is managing to grow its sales year on year from last 5 years, from last 3 years, and the latest 12 trailing months. So since last 5 years the company's sales have been compounding. This is not a average growth rate, this is the compounding, meaning every year it is increasing by that percentage. So almost 20% in last 5 years growth rate. From in March 15 the total revenue generated was 1709 crores, and in March 20 it increased to 4115 crores. So this shows that the company has a lot of demand for its products, and therefore we see a constant growth over last 5 years. In the last 3 years the growth rate has slowed down slightly to around 16.3%, but even this growth rate is very high. From March 17 the total revenue generated through sales was 2616 crores. Now this value is very important to look, because this is the starting point from where everything comes down to profits, to taxes, how much tax the company will pay, whether it will be able to pay its interest cost. Because if there is no demand for its product, then it's best not to it's best to avoid the company, because it will ultimately come into a lot of problems if there is no growth in its sales or there is no demand for its product, what it is manufacturing, what it's producing. To 4115 crores in March 20, that's a 16.31% growth over the last 3 years. As we earlier saw, from March 20 to the recent 12 months till June 2020, we've seen a slight dip in the overall sales from 4115 crores to 3977 crores. That's a drop of just 3.36%, a minimal drop in its sales, and this is also understandable because of the COVID situation. In terms of how the profits have been growing or compounding over 5 and 3 years, in the last 5 years the profits have been compounding at around 24.5%. In March 15 it had earned 116 crores as net profit, and in March 20 it was 346. That is a compounding of around 24.5% over 5-year period, whereas in the last 3 years it has growing at 17.1% in its net profit. So these are both good values. In fact, in the recent 12 months also, it has managed to increase its profit. Rather, even though the sales had dipped a little bit, but the profit has gone up from 346 to 358 crores, or 3.2% growth rate from its March 20 values. Let's look at the debtors turnover, that is, as a percentage of total sales, how much debtors, or from how much payment was to be collected from the debtors. Again, we saw even balance sheet wise it was very minimal, and as a percentage of total sales, that is 4,115 crores of sales was done in March 20, and only 89 crores was pending in the balance sheet to be collected from its customers. So the company is receiving most of its money in cash or through CFO, cash from operating activities, what it is doing in sales. So many companies do show a very good sales figure but don't receive payment from its customers. So most of it is in credit, and therefore the company is not receiving money in terms of cash, and therefore all these red flags pop up, and therefore we have to be careful and see if the company is doing sales, is it receiving or is it collecting the payment from its customers immediately and efficiently. Throughout the years, we can see the debtors turnover in terms of against sales, how much was to be collected from the customer from 15, 17, very minimal values, and it is collecting payment from its customers in within 8 days, and in March 17 it was even faster at 3 days, in 15 it was around 7 days. So the company is very efficiently collecting payment from its customers and not extending it beyond 9 or 10 days. Even in March 20 it was a good value of just 8 days. So the company is cash surplus most of the time, and therefore can use that money to put into investing activity or keep it as a cash holding for emergency use. Raw material cost for the company has always been very high at above 80% throughout the years, and we can see that in March 15, 17 and 20 also. But the company has been sustaining or keeping its raw material cost at around this level throughout the years, and therefore we can see that stability in the raw material cost. Employee cost is minimal at around less than 3% throughout the years. Interest expense is minimal at 2 crores in the recent 12 months. Earlier in March 20 it was just 4% or 4 crores, which is just 0.1% of the total sales. So this is very minimal. Depreciation also, because the company doesn't have that much of assets, is just 38 crores, and we can see in March 20 and 17 also it was 14 crores and 38, so minimal, below 1% throughout the years. Company is paying around 20% in March 20 as taxes, 99 crores out of the 485 crores of profit before tax. Earlier in March 17 it paid around 32.8%. Sometimes the companies defer their taxes to increase their profits, so this needs to be monitored carefully as to whether there are deferred expenses or tax expenses that the company is doing, and that can be seen by looking at the cash flow statement to see how much the company has deferred taxes, to see how much it is paying and how much it is deferring and why it is doing that, if it's a manipulation or if it has a genuine reason to defer those taxes. Other income is contributing around 2% in the recent 12 months. 80 crores was contributed to the total income, or rather sales, against the sales of 3,977 crores. Other income was around 80 crores. So the company through other investments is also generating kind of a profits for the shareholders to increase their net profit. So this is not a very substantial portion, should not be more than 10 to 20% of the total sales, otherwise it is too manipulative. Also we should see that it has a consistency in the amount of other income it is generating over the years. If there is a lot of fluctuation, then that other income has to be discounted. Average OPM of the last 5 years was around 13.5%, and in the recent 3 years it has increased to around 14%. Although this is below my benchmark of 15%, we have to see how consistently it is doing over long-term periods. The average NPM has always stood at slightly above 9% in the last 5 years and 3 years. So even though its average OPM is low, because its interest cost is very low and depreciation cost is very low, most of it is able to convert into NPM of around 9.2% in the last 5 years, and around in the recent 3 years increased slightly to around 9.8%. Although in the recent 12 months it has dipped to around 9%. Next, let us compare the net profit and how much cash is coming in front of that net profit. Many times company declare a profit but don't receive cash, like doing credit sales and so on. And therefore we have to make sure that whatever company is showing as profit is coming in by way of cash from its operating activity. So in March 15 there was a shortfall of cash by around 23%, whereas in March 17 there was additional excess cash of around 29% against the profit. So company had declared a profit of 216 crores but received cash of 278 crores from its operating activity. In March 20 that situation has completely reversed, and although it is showing a profit of 346 crores, most of it is not come in by way of cash. The cash has dipped to around 125 crores or 64% shortfall in terms of cash received from operating activity against the net profit declared. So this needs to be investigated by looking at the cash flow statement as to why there's this huge difference between the profit declared and the cash received through operating activity. If you look at the long-term averages of 7 years, last 5 years and 3 years, we can see that all throughout these average years there was always a shortfall of around 30% in the last 3 years. That is, out in last 7 years the company had declared a total profit of 1,626 crores, and against that cash came in was only 1,134 crores. Mostly I would like the cash coming in to be more than the net profit declared, or at least equal to that. In the 5 years also it's around 31% shortfall in terms of cash, and in the last 3 years that has increased substantially to around 45%. So although the company has shown a profit in the last 3 years of 1,067 crores, it has not received that cash. In fact, it has received almost half of that as cash, and the balance has not come in. So why it has not come in, that needs to be seen by looking at the cash flow statement separately. Next we'll look at how the company has earned cash from its operating activity and how much it is investing, or how it is investing in the investing activity part. So in March 15 company had received 89 crores, and out of that entire amount almost 84 crores of that was put into investing activity. Similar situation in March 17 where it earned 278 crores but invested 408 crores in its investing activity. So this needs to be monitored, but we'll pay attention to March 20 values, where out of 125 crores only 26 has gone into investing activity. Now this investing activity would include investments in fixed deposits, mutual funds, shares and so on, as well as purchase of fixed assets for the company. So this includes all of that, and therefore we need to segregate as to how much of this is on fixed assets, development of fixed assets, and how much is pure investment activity. So this is not good, not bad, but we need to see what is the constituent or what are the parts of this particular activity, and that we can come to know by looking at the cash flow statement, again the investing part of that cash flow statement. If you look at the long-term trend, in the last 7 years whatever cash the company had generated was put into the business, or rather transferred into the investing activity of 834 crores, or 74% of the cash earned was put into investing activity. And in the last 5 years 72% of that went into investing activity, and in the recent 3 years 55%. So in the last 3 years the company had earned 590 crores of cash from operating activity and put in around 320 to 55% of that into investing part. So we can see that the company is consistently increasing its investing activity, but rather average wise it is decreasing. All of these ratios are very important to understand what is happening within the company, what kind of manipulation, if any, is taking place. Net profit margin on the total sales in March 20 of 4,115 crores, the company had earned a net profit or declared a net profit of 346 crores, which is around 8.4%. Over the years, the trend has been increasing from 8.2 to 8.4 and now 9% in the recent 12 months. The profits have been gradually increasing. The sales has slightly dipped from March 20 to the recent 12 months. If we look at the cash profit margin, that is, first we compared sales with the net profit, now we're comparing sales with the operating cash flow. How much is the amount of cash that is generating and what is the margin in terms of cash? That has substantially dipped, as we saw earlier. In March 20 against the profit declared, the company had a huge shortfall in its cash received. So therefore, on a total 4,115 crores of sales, the company has received just 125 crores in cash, and therefore this needs to be investigated again. Any kind of variation in the cash flows needs to be monitored closely by looking at the cash flow statement. So only 3% of the total sales was received in cash, and therefore needs further investigation. This is an important part of the analysis and therefore should not be skipped. Let us look at the depreciation policy. That is how much depreciation the company is deducting on the total gross block or total assets. In March 20, the total assets were around 309 crores. On that, 38 crores was transferred to the P&L account as depreciation expenses, which is around 12.2%. So we can see an upward trend in the amount of depreciation it is charging to the P&L every year, from 8.9% to around 12.2%. As the assets increase, the depreciation value will definitely increase, but as a percentage it should be quite stable and not have a very high variations. Dividend payout is around 20% throughout these years, except for March 17 where it was around 18.9%. So the company is paying a substantial portion, or rather just 20% in March 20. Out of 346 crores of net profit, 69 crores was paid off as dividend, which is around 20%. So this is good because most of the balance it is in putting it back into the business to increase the net worth, and that's a good policy because we don't want to pay out too much dividend, and if the company requires that cash over the years, then it can use that for growth purpose. But it depends upon company to company as to how much money it is keeping in its reserves for future use. Current ratio is healthy at above 1 times throughout the years. Most of it current liabilities can be paid off using the current assets. March 20 total liabilities to be paid in that year was 475 crores, and company had huge assets of around 903 crores which it can comfortably pay off. So it had more assets, 1.9 times more assets than the liabilities it had to pay. So company is in a good, comfortable liquidity position. Inventory turnover is all above 7 times throughout the years, and this ratio is very important to understand against the sales, against the inventory holding. How much times more is the sales taking place in the company, and we should look at a stable figure that the company throughout the years. So there should be a proportionate ratio between how much inventory it is holding against how much sales it is doing in that year. So in March 15 it was the total sales done was 7.7 times more than the amount of inventory it was holding, and therefore we can see that throughout the years it's quite stable. In fact, in March 20 against total sales of 4,115 crores, its inventory holding increased marginally to around 544 crores. So this shows that the company is doing its inventory management or keeping its inventory management within control, and that is very important to look at how efficient the management is in terms of managing the inventory holding. Interest coverage ratio would be high because the interest expense is very low, and the company's EBIT as of March 20 was around 489 crores, and on that it had to pay just 4 crores for the entire year, which is a very high multiple. That is, company can easily pay off its interest expense whenever it wants. Market cap to sales ratio is a valuation ratio, tells us how much times or how much more expensive are we buying against the sales done by the company. In March 20, the company's total market value or value in the market was around 4,008 crores. But against that, the company had done a sales of 4,115 crores. So it has done almost the the same value of sales was done as it was valued in the market. So this is a very good value to look at. We want to see a sales more than its market cap, so therefore we are buying at a good valuation. But in the recent 12 months, that valuation is increased quite substantially. Its market cap has gone up to 7,291 crores against the sales of 3,977 crores. So whenever we see a multiple of around 1 times, is a very good time to buy into the company. In fact, in March 17 also was a good multiple of 1.3 times. But here it's become slightly expensive. That is, a recent market cap to sales or price to sales ratio has increased quite substantially to around almost 2 times from where it was in March 20. So within these 3 months itself, the company's valuations have gone up quite substantially. Price earning ratio is around 20.4 times. My benchmark is 25 times. So anytime it is below 25, I consider it to be reasonable. In the recent 12 months, the price of each share was, or the latest price per share is 535 rupees, and on that 535 it is earning around 26 rupee 20 paise per share. So therefore the price is around, we are paying a price which is 20.4 times higher than its earnings per share. We can see its trend as to how it was over the years of 5 and 3 years and see where it is recently, and then consider whether we can weight downwards towards its average. So right now it's at 20.4 times. Although it's below my benchmark, it is above its 5 and 3 years average. So we can wait for this 20.4 to drop to somewhere between 18.2x and 16.3x, that is average of 5 and 3 years, and buy between these two or below this as well, whatever the opportunity is provided or whenever that opportunity comes out. So we can use these valuations ratios to time our entry along with technical analysis. Price to book, that is against the net worth, what is the market cap. So company's market cap was around 7,291. This is the latest market cap of the company, and its net worth of 2020 March 20 was around 1,404 crores, which is around 5.2 times, very expensive. This was a good opportunity in March 20, which most of us missed out to invest into the company at 2.9 times. Although my benchmark is 2.5, we can look at the long-term trend again of how the price to book has behaved in the last 5 years and 3 years on average. Although I have not created a chart of that, but from next video onwards I'll create an average of that also. So March 20 and March 17 it was, rather in March 20, end of March 20 it was 2.9 times. A good time to buy into the company, which most of us missed. In the recent 12 months it has gone up back to its March 17 valuation of 5.3 times. So it's become quite expensive compared to its net worth or market cap, and therefore we need to wait patiently for it to come down slightly, either price to earning or price to book. Let's look at the debt. Again, this is a ratio which will help us understand how much is the debt against the net profit. But earlier we have seen that company's debt is very minimal at just 2 crores, and the net profit earned in March 20 was 346. So company can easily become debt free by paying off this 2 crores if it wants to. Let us recap the valuation ratios. Price to earning is below my benchmark of 25 times. Price to cash is very expensive at 58.3 times. I would not want to buy when the price to cash is so high, and this needs to, either the company needs to increase its cash or its market cap needs to come down, either of the two, for the price to cash ratio to come below 25 times. I would want to buy when both price to earning and price to cash are below 25x. Price to book is also very expensive at 5.2. Market cap to sales is still reasonable at 1.8 times, although it was available by March 20 at around 1 times. So most of us have missed that opportunity, but that's okay, because markets would keep giving us a lot of opportunities if we wait patiently. Let us look at how the prices have grown over the years. In the last 7 years, that is from March 13, in March 13 the price was just 7 rupee per share. This is adjusted for all the corporate actions like bonus, dividend and whatsoever rights. So it was 7 rupee 10 paise, which has gone up to 535 rupees. So whoever had bought in March 13 has increased their value by 7,493% or 85.6 time percentage compounding every year since last 7 years, which is a very high growth rate. In fact, even in the last 3 years, that is, if someone had bought in March 15 at 102 rupees, that too would have compounded at 39.2% every year since last 5 years. Whereas if you look at the actual growth from 102 to 535 rupees, that's almost 4.2x or 422.4%. From March 17, that is in the last 3 years, the compounding has been slowing down from 7 years, 5 years and 3 years, but even this compounding of 29.6% in the recent 3 years is also very good. That is, whoever had invested in March 17 3 years back has almost doubled their money, that is 117% return in last 3 years from March 17 to the current market price, that is from 245 rupees to 535. And therefore we can use this chart to understand that even if we invest for next 3 years, if not 29% or if not 30% rounded off, we can still expect around 25 to 20% of compounding for the next 3 years from here on. And therefore this particular chart gives us an understanding how the company has been increasing its prices, or how the company's prices have been increasing over the years. Let us look at the quarterly P&L analysis, profit and loss account analysis. Sales YOY June 19 to June 20 has dipped by around 12.6%, and quarter on quarter from March 20 to June 20 has dipped by around 7.7%. So there is of course a pressure on its revenue, that is, the sales has decreased in the June 20 quarter quite substantially due to complete lockdown of the economy. Profits have slightly increased in June 20 because the sales has dipped and the profit has increased to 104 crores. Therefore the margin has gone up to 10.9%, which was earlier in June 19 at 8.5%. So the sales has been declining over June 19, March 20 and June 20, and this is understandable because of this COVID situation, but otherwise we should see an upward trend going forward. If not, then that's a problem, and we should not buy right now because the valuation seems to be quite high as of June 2020. Let's see how the profits have been growing YOY from June 19 to 20. Although the revenue decline we have seen earlier in the earlier chart, but the profits have gone up from 93 to 104 crores. That's a 12% gain YOY. Whereas quarter on quarter from March 20 to June 20 has seen almost 20% of growth from 87 to 104 crores. So this completes my detailed analysis of the financial statement of Avanti Feeds. Next we'll look at the peer group analysis and maybe squeeze in cash flow statement as well to understand why the company's cash have been falling short of the profit declared, and then look at the technical analysis and intrinsic value calculation. The video will be a little long, but it's good that we analyze in detail to understand what the company is doing, how its financials are, how it is managing its resources like inventory, debtors and so on. So to get a complete know-how of what is happening, and therefore it gives us quite a good comfort in terms of understanding that our money is safe in this company and we don't need to keep worrying even if the price drops or price goes up. We can take a higher profit if the price goes up, if we have a lot of confidence in the company and the company's business is growing. And therefore it's best to put some time, an hour or two, to understand a company. When we are putting 1 lakh or 2 lakh in one company, it's worth 1 hour spending to understand in detail what is happening.